It seems like every day we're getting two messages. The first message is from our politicians who are saying that everything's right, the economy is going okay, and we're going to just hit a soft landing with all of these rate increases. That's fine. Then we open up the newspapers and we get headlines like this: there's a doom loop happening. And so I don't know what to believe, but as far as I'm concerned, it just makes everyone nervous. And so the Wall Street Journal just put out an article saying that these banks, these regional banks, could end up in a doom loop scenario. Well, what does that mean to us as value investors? And that's something that I'm going to dive into in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now let's take a look at this article. So this was posted by the Wall Street Journal. He said the real estate doom loop threatens America's banks. And so regional banks' exposure to commercial real estate is more substantial than it appears. Now I would be upset if I was one of these two people, because they are now the national face of the doom loop. I hope they get some good sponsorship opportunities, or at least some merch. And so this is what the article goes on to say. They're saying that banks are in danger of setting off a doom loop scenario where losses on loans trigger banks to cut lending, which leads to further drops in property prices and yet more losses, and so on and so forth. And so the question is, who's the most exposed to this? And you can see that since 2015, regional banks took on the lion's share of commercial real estate lending, because you can see that it's surged upwards, whereas the large banks did not take as much of an exposure. And so the question is, how is this doom loop scenario expected to play out? Well, the article goes on and says that the doom loop scenario is starting to play out in big cities where office vacancies have soared. Real estate investors that are unable to refinance their debt or can only do it at high rates are defaulting. The lenders no longer getting the debt payments often have to write down the value of those mortgages. Sometimes the bank ends up owning the property. And so really, when you think about how these loans are coming due, if you're going to be refinancing at higher rates, you can see that the regional banks really take on the exposure in 2024 and 2025. And so in this 4-year time horizon, many of these loans are coming due. Now, the question is, will rates remain higher for longer? If they do, many of these borrowers are exposed. And so is there something that the lenders could do right now to sort of save themselves? Well, a couple of things. One, they could have underwritten appropriately in the first place. And what I mean by that is underwrite at very low loan to values. Like, don't underwrite these things at 80% loan to value. Maybe underwrite them at 50% loans to values. And you guys are probably thinking that is a pipe dream. You can't underwrite these properties at 50% or less loan to values. I'm going to show you in this video a bank that they mentioned in this article that is actually has a whole portfolio underwritten at under 50% loan to value for the substantial majority of their portfolio. And so these banks are available. You just have to take the time and look through their disclosures and see what sort of risk is there. Can you find all the risk? No, it's hard, but you can get a really good idea about the underwriting capabilities of the financial institution, especially if it's been around for a long time. You can really see how they fared through recession, through a boom and bust cycles, and really get an understanding of exactly how management operates their bank. And that, of course, creates an opportunity, because if all the banks are going down simultaneously, you might be able to pick out a bank that has the opportunity to outperform the recovery when the bank shares eventually do recover. And this is what I'm talking about. You will see in a second that the article mentioned a bank by the name of Bank Ozick. This is one interesting bank because back in the springtime, when all the shares of all the regional banks went down, that's represented by this blue line. This is the KRE index. And you can see that it went down substantially more than Bank Ozick. And that's because the market believes that Bank Ozick in the yellow line doesn't have as much underlying risk or risk inherent in the operations as the industry as a whole. But it still declined. And so when you were looking at this in the springtime, you could have decided, hey, you know what? This bank got unfairly punished, and so it will probably recover faster to its previous share price than the regional banking index as a whole. And that's exactly what you saw. You saw that this line here, this yellow line, is much steeper than the blue line recovery. And so year to date, you can see that Bank Ozick is only down 2%, whereas the KRE index is down 26%. So, back at around this time, this is when I was picking up Bank Ozick. I actually wanted to buy more, but I was just upset at how it didn't actually come down as much as I'd like it to come down. And so it wasn't actually my largest regional bank position. It was my smallest regional bank position. I found other regional banks that declined substantially more, and they created a better opportunity. But overall, every single regional bank that I was investing in, I was looking at the risk inherent in the portfolio, and I decided to choose specific ones. And of course, they recovered substantially faster and greater than the KRE index as a whole. And so this is what I mean about the article, making it seem like Bank OZIC is in a little bit more risk than they actually are in. And I'll explain that risk in a second. But, the article did say that, Bank OZIC hasn't pulled back from lending, but it has started to see some signs of the market trouble. In January, a developer defaulted on a roughly $60 million loan from Bank OZIC after their construction costs escalated, which is happening all over the place, by the way. You get a price earlier on in the year, and then you're now looking to build, and the price is substantially higher. And then, you got lent an amount at a certain value, and if you can't build, you can't build. And so the loan was considered relatively safe because it was far below the building site value of almost $140 million in 2021. In December, a new appraisal was put on the property's value at $100 million. So it went down from approximately 140 to $100 million. The loan is for $60 million. So the loan is still covered with the asset, but unfortunately, the bank is now stuck with the property, and they can't offload it in the current environment because buying land at the current unstable environment is not something that a lot of people are doing. Now, Bank OZIC can do a couple of things. They can chop it up and sell it in smaller pieces, but I still think people are not going to be buyers of it in this environment. But you know what? You effectively took over a piece of land for $60 million, and if they even gave out all of that $60 million, because some of these construction loans, they take it as they need it. So they may not have taken all of that $60 million. So, at the highest level, they took on this land at $60 million, which is worth $100 million. So, 3, 4, 5, 6 years from now, will they be able to offload it? I think so. And I think they'll be able to recover everything. So I don't think that they're going to lose on this particular loan, but banks are not in the business of holding assets and holding land, like holding real estate and holding land. They just want to lend to it and back, of course, the loans with it. And so it's unfortunate that Bank OZIC is in this situation, but that doesn't mean that Bank OZIC is going to be in a scenario where they're just taking on more and more real estate and more land as their loans go bad, which is kind of what this article is implying by not saying how safe Bank OZIC's underwriting actually is. And this is what I mean. The substantial majority of Bank OZIC's loan to value ratios for their loans are below 70%, and like very much below 70%, because when you see this line right here, this 50%, you can see even the majority of the loans are below this 50% line. You can see that there's 2 loans up here where they actually reappraised the properties, and they realized that, there's one loan with a loan to value of 95%, and one loan with a loan to value of, so this is the 95% and this is 101%. They've spoken to each of the sponsors, and the sponsors are working to bring in new capital for these loans. However, the total value of these loans is 24 million plus the 128. The provisioning that Bank OZIC has is somewhere close to 500 million. So this is, if these 2 loans were to go belly up, the loss has already been covered through the P&L and is provisioned on the balance sheet with the loan loss reserve that they have. So worst case scenario, this doesn't actually impact the investors. I mean, yeah, it could cause them to continue to increase their provision, and they lose a big chunk of it due to this, because this represents approximately 30% or so of the provision. So yeah, but it's not a huge shock overall to the investors. Now, the point that I'm making here is that if a substantial majority of your portfolio of loans are, very much under 60%, then how low do property prices have to get before you start taking losses on these loans? And that's really the issue. Now, one thing that could happen is that similar situation that's happening with Bank Ozic right now, where these developers just don't have the cash flow, so they just hand over the land or the real estate, and it is worth more to the bank, and so the bank just takes it on, and so that could actually end up hurting the bank. So I understand what the point of the doom loop scenario is. But if that starts happening on a pervasive level, I think you're in an environment where there's a substantial amount of deflation. And I would think that regulatory bodies, the Fed, whoever would step in and try to alleviate that. And so I'm not really convinced that the doom loop scenario is going to play out. And then diving a little bit deeper into their portfolio, you can see that the real risk is in office real estate and hotels, I would say. Not a lot of people are talking about hotels, but they're really just talking about office right now. So, when we think about risk from a diversification perspective, the real risk is in office. Well, overall, I always say that commercial real estate exposure is not one monolith item. So, if you were to go back into that other chart that I was just showing you, not all of those loans are actually, those ones actually might all be real estate depending on how they're showing it, but basically not all of the loans in their overall portfolio is commercial real estate. Excuse me, I meant to say office real estate. In fact, what their commercial real estate loan portfolio consists of is many types of loans. And so if you try and understand this, you're not seeing a doom loop scenario in multifamily homes, in mixed use homes, in condo buildings, in just, retail, etc. You could potentially be seeing a doom loop scenario in the office real estate space. And so, you want to make sure that the bank is geographically diversified and also loan size diversified and industry diversified. But the other thing you want to see is that, do they have a low loan to value ratio? And so look at this, pay attention. The loan to value in the office portfolio is 41%. So in order for them to take a loss, you would have to have a substantial loss in the value of the property. So what this is this is a real opportunity for value investors in the event that a mass share price decline event occurs in this space, because there are some banks that'll be more well suited than others. I also see the potential of a recession risk with hotels, because we're in an environment now where if things get worse, companies can still continue to operate even if they have to slash their hotel budgets, their travel and entertainment type budgets. And so, hotels are at risk, but when you have a 37% loan to value risk with hotels, I think you're fine. But once again, the major point of this slide is to show that commercial real estate is not one monolith item. It is many different types of exposure, and not all of those exposures carry the same risk. And so the important thing is to see what percentage of the commercial real estate portfolio is in those concentrated risk or higher risk areas right now. And you can see that it's just office and it's hotel, and it's a minority of the overall portfolio. And then just looking at the sizes of the loans in the portfolio. So, they are extremely well diversified, both geographically and in concentration of the different areas of commercial real estate that they're invested in, but they're also diversified in terms of loan sizes. So you can see that you don't want to see huge jumbo loan exposure. So you can see that the 500 million plus loan exposure is a substantial minority portion of the portfolio. The substantial majority of the loan portfolio is the smaller loans, 266, 54. It makes up a substantial amount of the overall portfolio. And there is no grouping that's even close to 50% on a loan to value basis. And if you're wondering what this blue dot here is, this is the LTC ratio. This is loan to cost ratio. So in other words, the amount of loan to the cost to build the project. And so even on a loan to cost basis, these loans are very low. And so they're very safe overall across the spectrum of size. And so despite that, the company, recall, they have provisioned $427 million as of this past quarter, and they'll likely continue to increase it. And just a reminder, those two revalued loans that we chatted about earlier amount to $152 million, or 36% of the provision. Okay, so essentially what's happening is that the company has more than an ample provision just in case if those two loans go bad. I don't think that they do, but if they do, The company has more than enough provision to cover it. And, the company has been aggressively increasing their provision anyways. And so they said over the last 4 quarters, we maintain a cautious outlook on macroeconomic conditions with our weightings primarily to the Moody's S4 alternative adverse downside scenario and the S6 stagflation scenario, resulting basically they're being super conservative and very cautious in their outlook for the economy, resulting in a cumulative provision expense of $150 million, even though their net charge-offs were only $23 million. So, 150 million divided by 23 tells you that they're provisioning 6.5 times higher than what the losses that they are actually seeing on their portfolio. So that speaks to how conservative this bank is. And you know what? It's not just where the provision is right now. How have they provisioned over the last 5-10 years when these scenarios didn't exist? And I went back and looked at that, and you can actually see it in the comps schedule that I prepared for everyone, and I've updated for Q2, and you get access to at that higher tier of the Patreon. So if you want access to that comps, you can join us at that higher tier, and you also get access to our monthly calls and all of that stuff. So consider that if you want. But what you see in that is that they've always been very highly provisioned, even in environments that the risk wasn't substantial like it is right now, or like risk wasn't elevated, like it is right now. And, a lot of people are worried that, or at least in the spring, a lot of people were worried that, deposit might go away. You can see that, deposit risk is not an issue for Bank OZIC because most of their deposits are generated through their network of 230 retail branches. And you can see that their deposit amounts kind of have stayed the same, if not grown a little bit more. So, total deposits were $20 billion and now they're $24 billion. So deposit flight risk for Bank OZIC is not the issue. However, I want you to pay attention to these numbers. Take a look at this. Let me make this a little bit bigger for you. You can see that the consumer non-time deposits are actually declining and the time deposits are actually increasing. And what that means is that consumers are putting more cash to a higher interest bearing deposits. And what that's doing is that's actually compressing the net interest margin for Bank OZIC. And this is actually an industry-wide issue. So Bank OZIC has been very clear about this. They're saying that, expect their net interest margins to compress as the year goes on and as interest rates stay higher for longer, essentially. And so they're thinking that it's just going to normalize because they actually increased the rate that they were charging their borrowers faster than their depositors have been moving their money from checking accounts to time deposit accounts where they can generate a higher rate of interest. But it is happening, and this is not just a risk that's impacting, or not just an issue that's impacting Bank OZIC. This is something that's impacting the industry as a whole. And so what you kind of want to look at is, how is Bank OZIC performing relative to the industry? And the cool thing is that they actually provide a slide showing that, so you can see that. Notice, as predicted in Q1 by myself and management, but really I was just articulating what management was saying, is that the NIM is beginning to compress. You can see that it's declined quarter over quarter, but as shown with the FDIC insured institution line, the FDIC insured banks are also their NIMs are also compressing. And so when you see the Q2 data come out, you'll see that it actually comes down significantly more, or considerably more. And so they're continuing to outperform the industry, but they're going in the same direction as the industry. So just pay attention to that. Now, the question is, what made me so confident with Bank OZIC? Well, you guys might recall that I took some time away from YouTube. I got sick with COVID earlier in the spring, and I couldn't really talk, but I could still do research. And so what I did with my time away from YouTube is I actually analyzed 63 national and regional banks using many key performance and risk indicators, not Rick, we don't know who Rick is, risk indicators, including the 9 up above. And what I did was I compared these banks against one another using these risk indicators. And that's how I found that Bank OZIC, US Bancorp, M&T were some of the best run banks in America. And then using their valuation, because I also have have a metric that's called, average return on tangible equity divided by current price to book, which tells you, what the return on investment could potentially be for you. I was using that metric to determine which banks I'd like to allocate capital to, also taking into account the risk inherent in the bank and a whole slew of other indicators. But it allowed me, this tool here allowed me to really determine which banks I wanted to analyze on a deeper level, and then which ones that I'd want to allocate capital to. And of course, it ended up doing very, very well. And then the other thing I did was, while I was building that, I also made a regional bank analysis course for you guys. And so it showed you how to review the key performance indicators for the banks, apply those key performance indicators to the banks, and then I provided my personal ranking of the banks that were analyzed. Now, my personal ranking has changed, but the whole point is that this course, it's a 3-hour course or 2.5-hour course. It allowed you to sort of like understand the space a little bit better. And once again, just quickly, you can get access to the comps schedule and the live courses all on the higher tier of the Patreon. And if you just want access to the models that I have access to, you can get access to the models at that lower tier. And so overall, I really thought that this article was really funny. It called out Bank Ozic, but Bank Ozic is probably not the one that you want to call out. There's a lot of banks that you could have called out. I have a few names in my mind that I would immediately rush to call out, but I won't call them out publicly. But if you go onto the comp schedule, it'll be pretty easy to see which ones they are. But I'll leave it there for you guys. You guys let me know if you're investing in the regional bank space, or if you're waiting for these names to come down a bit to buy some more. I'm personally waiting for these names to come back down a little bit, and I'll allocate more capital into it now that there's more capital available in the portfolio. And so let me know what you guys think, and I'll leave it there for you guys.